What if I told you that one of the most powerful global currencies isn't the dollar, isn't the euro, and wasn't even considered fully global just a decade ago? And yet today it sits at the same table as the world's financial giants. We are talking about the Chinese yuan, a currency once tightly controlled, rarely used outside its borders, now officially part of one of the most exclusive financial clubs on earth, the SDR. So how did that happen? How did a currency from a still developing financial system manage to join a basket that includes the US dollar, the euro, the British pound and the Japanese yen? And more importantly, was this just a symbolic move or a signal that global economic power is quietly shifting? Because this isn't just about currency, it's about influence, it's about trust, and it's about who gets to shape the rules of the global financial system. In this video, we are going to uncover how the Chinese yuan made its way into the SDR basket, what had to change for that to happen, and what it really means for the future of money and global power. But before we dive in, you need to understand one key thing. Getting into the SDR is not easy. It's not political theater. It's not just about size. It's about meeting strict criteria that prove a currency is stable, widely used, and trusted around the world. And for years, many believed China simply wasn't there yet. So what changed? Let's break it down. Let's get straight to the facts. In 2016, the Chinese yuan, also known as the renminbi, was officially added to the special drawing rights SDR basket by the International Monetary Fund. And this wasn't just a symbolic inclusion. At the moment of entry, the yuan received a weight of 10.95 in the SDR basket. That's really a lot. Let that sink in. That immediately placed it ahead of both the Japanese yen and British pound, currencies from highly developed, long-established financial systems. Here's how the SDR basket looked after the yuan was added in 2016. US dollar 41.73%, euro 30.93%, Chinese yuan 10.92%, Japanese yen 8.33%, British pound 8.09%. So that natural question is, did the yuan replace one of these currencies? The short answer is no, but it still came at a cost. Before 2016, the SDR basket had only 4 currencies: the dollar, euro, yen, and pound. When the yuan entered, the basket expanded to 5 currencies. However, the total must always equal 100%, which means every existing currency had to give up a share, a little of place. And here's where it gets interesting. The biggest relative loss come from the euro. Why? Because the euro had previously held a much larger share, over 37% in earlier configurations. By 2016, it dropped to just under 31%. The British pound and Japanese yen also saw their weights reduced, but they were already smaller players, so the impact was less dramatic in absolute terms. Even the US dollar, despite remaining dominant, gave up a small portion of its share. So rather than kicking anyone out, the yuan forced a redistribution of global monetary power inside the SDR. And symbolically, that matters, because for the first time, a currency from a non-Western emerging economic system secured a double-digit share in what is essentially the IMF's elite currency basket. That wasn't just inclusion, it was recognition. Recognition that China had become too important to ignore in the global financial system. But here's the real question. What did China have to change to earn the spot? Because the IMF doesn't just hand out seats at this table, and that's exactly what we will explore next. Now here's where things get really interesting, because the story of the yuan in the SDR didn't end in 2016, and it didn't even stop in 2022. In fact, the next big turning point is already on the horizon. 2027, that's when the International Monetary Fund will conduct its next full review of the SDR basket, something that only happens once every 5 years. And if you have been paying attention attention to the trend, you already know what might be coming, because between 2016 and 2022, the yuan didn't just stay in the basket, it gained ground. Its weight increased from 10.92% to 12.28%, making it third most important currency in the SDR and narrowing the gap with the euro. At the same time, the euro, yen and pound all lost share, so the direction is clear. The real question is, how far can this go in 2027? Some analysts and financial institutions are already hinting at a scenario where the yuan's weight could climb even further, potentially into the 13 or 15% range, depending on how China's role in global trade and finance evolves. Why? Because the IMF's formula is heavily based on two things: a country's share in global exports and how widely its currency is used internationally, and China continues to dominate global trade. So from a purely mathematical perspective, the yuan has a case. But here's the twist: China doesn't just want a higher percentage. China policymakers have been pushing for something bigger. They want greater recognition of the yuan in global reserves, more international use in trade settlements, and a financial system that is less depending on the US dollar. In fact, Chinese officials have repeatedly emphasized the need to expand financial market openness and make that yuan easier to use globally, precisely to strengthen its position in frameworks like the SDR. Because of China, this isn't just about a number in a basket. It's about rewriting the balance of power in the global monetary system. But there's catch, and it's a big one, because increasing the yuan share in 2027 would almost certainly mean someone else has to lose even more ground. So the real battle isn't just whether the yuan goes up, it's who goes down, and that's where things could get political. We will break down that in the next. So if the yuan is expected to grow in the SDR basket in 2027, there's no way around it. Someone has to give up space, because the SDR is a fixed pie, 100% total, no exceptions. So let's break this down logically, not politically, not emotionally, but based on how the IMF actually calculates the weights. The formula depends mainly on export strength and how widely a currency is used globally in finance and reserves. Now look at the current landscape. Chinese share in global exports remains massive, often competing with or exceeding that of the entire Eurozone. At the same time, the international use of yuan is growing, even if it still lags behind the dollar and euro. So if the yuan climbs from 12 toward, let's say, 13-15%, who is more vulnerable? Let's go one by one. The US dollar? Highly unlikely, but we don't know what will happen after the Strait of Hormuz. The dollar still dominates global finance, from trade invoicing to central bank reserves to debt markets. But of course it can change. But even if it loses a fraction, it's not the primary target. Well, for now, of course, we don't know what will happen in 10, 5 or 15 years. The euro? Possible, but complicated. The euro has already taken a significant hit in previous revisions, and while Europe remains a major exporter, its global financial influence has been relatively stable, not growing. Still, politically and structurally, the euro is too important to take a major cut again without resistance, and we have to remember that more countries from the EU can join Eurozone, like Czech Republic, Poland or Hungary, making euro even stronger. What about the Japanese yen? Now we are getting closer. Japanese share in global export has been gradually declining over the years, and the yen's international usage, while still significant, hasn't been expanding. This makes it one of the most exposed currencies in the basket. What about the British pound? Also vulnerable, maybe the weakest, weaker than yuan and the weakest of all Western currencies. The UK economy is smaller compared to the US, Eurozone and China, and after Brexit, London's global financial dominance, while still strong, faces more competition. The pound already holds one of the smallest share in the SDR, which creates a paradox. It's small, but that also makes it easier to cut further. So if we follow the data-driven logic, the most likely scenario is this. The yuan gains share primarily at the expense of the yen and the pound, with smaller adjustments possibly coming from the euro, but only if no more countries will join euro, and minimal impact on the US dollar. But here's where things get interesting again, because this isn't just a spreadsheet exercise. Every percentage point shift in the SDR is a signal about global trust, about economic influence, and about who is rising and who is slowly fading. So if the yuan does expand its share in 2027, it won't just be a technical adjustment, it will be a message that the center of gravity in the global financial system is continuing to move slowly but unmistakably toward China, and the world will be watching very closely. Now let's fast forward, not to 2027 but 15 years into the future, because if current trends continue, the question is no longer whether the yuan grows, but how dominant it can become inside the SDR system. So what could the yuan share look like around the early 2040s, based on long-term projections tied to China's role in global trade, gradual internationalization of the yuan, and increasing use in cross-border settlements? A realistic, not extreme, scenario puts the yuan somewhere in the range of 15 to even 18% of the SDR basket. That would firmly secure its position as the clear number 3 and potentially start closing the gap with the euro. But here's the key: for the yuan to reach that level, others must shrink. So who takes the hit over the long run? Let's be precise. The British pound is most structurally vulnerable. Why? The UK economy is relatively smaller, its share in global export is limited, and while London remains a financial hub, its dominance is under pressure. Over a 15-year horizon, there is a real scenario where the pound drops to a very small share, around 4% or lower, or even risk removal, if the IMF ever decides to restructure the basket more aggressively. The Japanese yen faces a similar, tough, slightly less dramatic trajectory. Japan's export share has been gradually declining, economic growth remains slow, and the yen's global usage is not expanding significantly. This makes the yen a likely candidate to lose further weight, potentially failing into the 5-6% range. What about the euro? The euro will likely remain a core pillar, but it may continue to gradually lose share, especially if Europe's growth and global trade influence stagnate relative to Asia. But remember, more European countries can join euro, making euro bigger, pumping euro size. A plausible long-term range, 25% to 28%, down from over 30% in 2016, and the US dollar still dominant, but even the dollar isn't immune. As the system becomes more multipolar, the dollar could slowly edge down from the 40% plus range to something like 35 to 38, or even lower, still number one, but less overwhelming. So what does the SDR look like if the composition stays the same? Here's realistic long-term projection: US dollar 35-38%, euro 25-28%, or 30% if more countries join, Chinese yuan 15-18%, Japanese yen 5-6%, British pound 3-4-5%. But what if the basket changes? Now, this is where things get speculative, but granted, there has been growing discussion about whether future SDR reviews could include currencies from other major emerging economies, or better reflect the multipolar global economy. Potential long-term candidates often mentioned in financial cycles include the Indian rupee, possibly a more internationally used digital currency system, but inclusion is extremely difficult. The IMF requires currency to be widely used in international transactions, freely usable and accessible, and most Most emerging markets currencies, including India's, are not there yet, so will the pound be removed? Not likely in the near term, but if any currency were to be pushed out in major restructuring scenario, the pound is the most exposed. Final insights: who loses the most from the yuan rise? Not one currency, but a group. The yen and pound lose the most in percentage terms. The euro loses in absolute share. The dollar loses in a symbolic dominance. And that leads to a bigger conclusion. The rise of the yuan in the SDR isn't about replacing one currency overnight. It's about something slower, but far more powerful and gradual redistribution of global financial influence. And if the next 15 years follow the currency trajectory, that shift is far from over.